Hey mom, how's it going?
It is going really well, Lindsay. I am back in Hilton Head enjoying a beautiful sunny day. I think we might actually wrap up the day and head out on the boat this afternoon. How about you?
I'm doing well. Not that well. My plans tonight are like pizza on the couch, Harry Potter, but I don't have a boat, so there's that.
Yeah, there's always things that you can reach for, Lindsay. Just remember that. You can always reach higher. It's all good.
But then I
Anyway,
would
we
abandon
are
Harry Potter, man. That wouldn't be
yeah.
fun.
I don't like Harry Potter. Okay, so we've got an amazing, amazing guest. I have the pleasure of knowing her for a couple of years. We have the lovely Morgan Harris joining us. She is the senior loan officer at Live Oak Bank and a good friend. Welcome, Morgan, to the show.
Thank you for having me. I really appreciate being with the Wallace girls today.
Yeah, it's a fun time. Let me tell you, you just have no idea what we're going to get into. So, buckle up, my friend, buckle up.
Edge of my seat. I'm ready. Let's do it.
So here's the thing. We're in this crazy market. You and we are in this crazy, crazy market. There's a lot happening. I know that you've been in the industry for a while, so you've seen all kinds of stuff, but I don't think anybody anticipated that we were going to have quite the shift in the market over the last 18 months. I would love to hear from your perspective with the challenges with hiring and interest rates and a hard market, technology, aging out. Like there's a lot of things happening. What are you seeing from a banking perspective, the impact to demand and also supply of M&A deals at this point?
So that's a loaded question to say the least. And where do you even start? There's a million different ways to look at it. I've seen it all and probably more, and continue to have these daily conversations from folks all across the country. I think marketplace overall, you look at California, you look at what's going on in Florida, just in the overall insurance market, and people doing everything they possibly can to keep their head above water, to keep their book of business. I mean, instead of being able to focus on bringing in new business, they're trying to do whatever they can to save what they already have. So I see a lot of stress and pressure around that. You talk about increased interest rates over even the last year and a half. We had prime a little over a year ago at 3.25. Now we're looking at 8.5 today. Is it going to normalize? Is it going to go up? Is it going to go down? Because you've got to cash flow those rates. I think overall in the marketplace, there's so much talk about valuations and how interest rates in the market, say in some of these hot spots, how does that affect the valuation? There's a million different ways to look at it.
Yeah. So what are you guys seeing at the bank? I think that there's this, I don't know, there's this assumption that if I have an agency that's certain size, that I should be able to get a certain price for my agency, which, now in this day and age, where you are, what your size is, what your situation is, can vastly, can really change and be vastly different agency to agency. What do you see? Like, do you see as many people coming to you and saying they want to buy or that they want to sell? Do you see a drop off in the people that are coming? Tell me, tell me what that looks like today.
Sure. I would say, as far as volume, we're probably the busiest that we've ever been. You would think that it would slow down, but there's always this need for change of ownership. I mean, there's all people always are going to retire. People are always wanting to get out of the business, or if a seller wants to get out of the business, there's always a reason for change of ownership, whether it's internal perpetuation, partner buyout. Things happen, people move, and need to sell their agency. So by means of volume, not seeing an adjustment there. With interest rates going up, you have to be creative when it comes to structure. And I think when you talk about valuations and multiples, that's my favorite. When a seller calls and says, "Hey, I'm 300 in revenue and I'm selling my agency for 4 times," tell me how that makes sense necessarily. And how can a buyer afford that? If a buyer just has an open checkbook, sure, have at it. But if you need a lender involved, There's a lot more that goes into it. So I think there's a lot of different components that you really need to take into consideration.
No doubt about it. And what's funny is, a lot of people ask me, is now the high, and is this the time that I need to get out, or is that, do we still have time? And I guess my answer to them is I've never been busier. There's more people now that are looking to acquire, which means demand is still high. And nothing actually structurally about an independent agency has changed. There is this retention rate. There's this renewable income that is really predictable so far in this hard market. Until that changes, I think that there's demand. There's definitely people that are looking to have happen. So I agree with you. I've been busier now than I was a year ago, and certainly that way busier than I was 2 years ago. And both of those years, I thought I was pretty damn busy. So it's kind of funny, right? It's nuts.
It's incredible. It's incredible. I mean, you look at the overall model of insurance agencies, it's recurring revenue. As long as they can keep their expenses in line and they're not overstaffed, they're not, paying for 4 different locations when they only need one, or potentially even remote. If they can keep their expenses in line, it's a gold mine.
Agreed.
I would love to dive a little bit into what you see agencies looking at when they are like looking to acquire an agency, like in the book of business, that helps them be super successful in that, like when they're buying that agency. Like, what are some of the specific things that they're picking out as, oh, this is why I want to buy this agency?
Sure. I think there's so much to look into when buying a book. And so I love having a conversation with a client. Number one, my first question I always ask is, why is the seller selling? What's the reason? And then what makes you interested in this acquisition? There's so many different reasons, but the things that they really need to look into, and I always ask everybody I talk to, I ask all of these questions to, look into the overall book of business. Or I guess let me rewind a second. You think about, folks will come to me and they say, okay, I'm buying this $500,000 revenue agency for 2 times commission revenue. Okay, well, why? Tell me about it. Tell me about the carriers. What's the carrier makeup? Is it mostly one carrier? Is it even across 30 different carriers? Look at the loss ratios. Those are really important to look into. You need to understand the loss ratios. Is it a scenario where the seller is potentially selling because the loss ratios are through the roof and they know that they're not going to get their contingency bonus next year? Client concentration, that's really important to dig into. Are there any, we always ask, is there any account that accounts for more than, say, 5% of commission revenue? Had a client approach me recently, and let's say it was a few $100,000 revenue shop, the target that they were looking at, and the top 5 accounts, this is commercial accounts, top 5 accounts accounted for 75% or 80% of the revenue.
Mm.
And the top one was, I think, about 40%.
Oh my goodness.
You lose one client, 2 clients.
Yeah,
It's
you're done.
really, really difficult. So not to say that that's not a good target, but you're not paying him cash at close. You need to structure that based on retention and pay out over X number
Yeah,
of
there's some
years.
serious risk.
So being
Yeah,
creative.
super, super risky. And what I love, Morgan, is when people want to think about, well, if my agency is 2 million in revenue and your agency is in 2 million in revenue, those 2 agencies should be the same price. Well, you just point in case, if 45% of my 2 million is in one account, that is far more risky than yours that, less than 1% in any one account. I mean, and that's one of how many factors that we look at when we think about the risk, right? It's just crazy.
Absolutely. Absolutely. And even technology. So as a seller, are they running all paper files, or are they actually utilizing an agency management system to the fullest? But going back to your comment about 2 agencies next to each other, both 2 million in revenue, you can have one of those agencies running off of a 10% profit where they're barely taking anything home. And on the flip side, the other guy's super efficient and he's kicking off a 60% profit margin, you definitely don't want to pay the same amount for both of those
No
agencies.
doubt about it. Or there's one that says, I'm happy to work with you for 3 years. And the other one is saying, hey, I'm going to sign the paper before it's wet. I'm going to be in Tahiti. Like those are very, very different scenarios, right? And the risk involved with it and the predictability of the ongoing performance is far different in all of those scenarios that we just said. So clearly the price would be different, but it's really interesting that there is this preconceived notion that you just use a rule of thumb, take your top line revenue, multiply it by a number and call it a day. That is not how it works, right? Definitely not how it works.
It's so interesting. And I even think about a call I had with a client last night, really large agency, family run. It's been around for about 70 years, over 10 million in commission revenue. So we started talking, digging into it a little bit more. Tell me about the business. Tell me about the carriers. Tell me about the producers. How long have the producers been around? What are your thoughts around the transition? The kicker with this one, which I thought was really interesting, the producers don't have producer agreements.
Oof.
No non-compete, no non-solicit. And it's
Whoa.
handshake agreements where technically the producers own their book of business. So the value of that agency is very skewed when you think about, say, the overall commission revenue, but the majority of that isn't even owned by the agency. It's almost aggregated premium.
Yeah.
So those producers could walk at any point and take their book.
So I had an agency where it was a similar situation and someone internal wanted to buy it. And really, she was like a starter agency. These agents could leave at any time, which was a great idea until she wanted to sell it. And then I'm thinking, but you realize there's nothing to sell. I mean, it's really your book you're selling, not the others, because they're super transient. There's no barrier for them to leave. It took a long time to actually figure that deal out, and they did, but it was about putting contracts in place with those other people or literally eliminating them from the deal because there is no predictability that they're going to be there in the future. You can't buy something that's not yours, and you can't sell something that's not yours. Like you just can't do that. It's mind-boggling a little bit that concept is hard for. But anyway, yeah, I've learned a lot going through some of these deals. There's no two ways around it, right? This is crazy.
And they're all different. I mean, they could be similar in a million different ways, but everyone always has their own quirk to
no
it.
doubt.
Mm-hmm. I'd love to dive a little bit in. You mentioned earlier, I'm going to forget what you said now, but I wanted to come back to it. Hang on.
Who knows?
Podcast number 5.
Save the best for last.
Exactly.
Oh my God, I had no idea. And I even thought to myself, I should write this down because I'm going to forget.
How they find opportunities, Lindsay?
No, it was going to lead me into different types of loans. I don't remember.
Okay, so Morgan,
Okay,
for the
whatever.
people out there, there's lots of different ways to finance a deal, and you guys are known for an SBA loan. So for those of the people in the world that don't actually know what an SBA loan is, can you tell us what that is and how it compares to a conventional loan?
Yes, absolutely. So SBA, Live Oak Bank, Wilmington, North Carolina, we have historically specialized in just SBA lending. So small business administration loans. We underwrite, approve, and service the loans in-house. We lend Live Oak Bank's money. However, a portion of that loan is backed by the government. And it's really set up to help small business owners grow without having to bring excess capital to the closing table. So it's friendly terms, minimal down payments, no prepayment penalties. And we really look at it from an overall cash flow perspective. So for an acquisition loan, an agency acquisition loan, you're looking 10-year term, interest rates based on prime. But if you have a great year of contingencies, you want to pay it down, you have the option to do so. What's really neat with these two is, say you have an existing agency and you're looking at a target, you can look at a minimal down payment on that next acquisition loan. So for instance, I sent out a loan proposal before we hopped on this today. and it was a $2 million loan. He has an existing agency, and he's bringing $7,500 to the table. So with the SBA program, you're not required to bring 15, 20, 30%. And most firms or most lenders are looking at 3, 5, maybe a 7-year term. So the SBA gives you a lot of flexibility there. Most of what we do are acquisitions and also some real estate. So for real estate, it's a straight 25-year term. So it's not a balloon payment like your typical local bank where you're redoing that every, say, 5 years. But we also do conventional lending as well. So we've been able to branch out. It's really just understanding what the client needs and their goals, and then creating a financing tool that makes the most sense for their particular scenario, not just now, but moving forward. Just understanding their plans.
I feel like all of these options are things that are just very unknown. Like earlier you said that you could do a loan but have it like contingent on the retention of those high profile. Like I had no idea you could even do that. You also mentioned that it like needs to cash flow. What does that mean?
So kind of going back a little bit to Carey's example around $2 million agencies next to each other. So I mentioned one running off a 10% profit margin and then one running off a 60% profit margin. So when we look at a deal, we're not just looking at the book of business. We're not just looking at the revenue multiples. We're not just looking at carrier makeup. We're looking at, when we're looking at the financials, a huge can support the business expenses, support a salary for the owner, support that new business debt with a cushion. So looking at expenses, revenue, ensuring that it can support the debt, and always ensuring that we have a buffer in there as well. We want to make sure the client's set up for success.
That's the key,
So you also
right? That's actually the key, because you can pick the price you want, but if you can't pay the loan and you can't run the agency in order to get the performance to continue to pay that loan, then what's the point? Like that's not a situation a bank's going to be in. That typically happens when there's no bank involved and someone arbitrarily picks a number because they think that's the number they should have. It really hamstrings the future owner from being able to actually run and invest the way they need to run that agency, right? I mean, it's kind of sad when you see that happen.
Back to, I always love having conversations with first-time buyers. So we work with a ton of first-time buyers and first-time sellers. So we'll schedule Zoom calls with buyer and seller, walk through every different, facet of the deal. But it's always interesting when they'll come to me and say, okay, the seller wants 75% cash at close, but then that remaining 25%, and it could be a large number, 50% cash at close, the remaining 50%, they want it paid out over 2 years. Well, if you back into that, those are some really high monthly payments on that seller note. So, and I'll always ask the question of, what are your long-term plans? Do you want to continue to acquire, or is this kind of a one and done? And most people say they're interested in future acquisitions. But if you have that amortization or that short-term repayment on any type of loan, whether it's a seller note, a bank loan, that required monthly payment really, to your point, hamstrings your cash flow. So if you stretch that out over, say, a 7-year, 10-year, even if you have a balloon payment and pay it off early, that required monthly payment over that 2-year period can really, really hurt your overall cash flow.
So you also mentioned earlier looking at like the carrier makeup.
Mhm.
So how does that impact a deal? Like if it's all with one carrier or with multiple different carriers, which is preferred, or does it just depend on the different deals?
Good question. I think there's a million different ways you can answer that one. I would say it depends on the carrier. It really depends on the carrier. Is it a non-standard agency that is set up next to the DMV for quick churn and burn business? Or is it, and there's a handful of carriers I can name that you hear certain names of certain carriers and your mouth waters. You get excited about those, and it's going to be a strong agency. The book of business is going to be really, really clean, and that book of business or agency is going to trade much higher than, say, potentially the non-standard agency that's next to the DMV. I have some clients that they primarily have one large carrier relationship, and others where they may shuffle between three. But when you have them divided up over, say, 30 different carriers, and there's no heavy concentration, if you think about reshuffling that and putting some focus on even a couple of those carriers, you may be able to start actually getting contingencies or bonus income. You may be able to bump up your commission rate with those carriers. It's a lot of those one-offs. You can also risk, if you only have a little bit of business with some of those smaller carriers, you may risk losing they could risk losing their appointment with that carrier because they're not producing enough business.
Yeah. That's an interesting topic to me because I actually work for a network. A lot of people think I work for my mom, but I don't. I work for like a small network,
He
and
works for you.
Amen to that,
yeah,
Morgan. Trust me,
exactly.
that is a very
Exactly.
true statement.
But we have a lot of members who are buying books and coming to us for networks, or also like agencies getting bought and moving out. And it's such an interesting like puzzle piece when you buy a book and you don't necessarily like have somewhere to put it, from both sides, right? From them bringing it into our network or also the network taking it out. And sometimes when agencies are buying our agencies who are members, their business stays with us because they don't have anywhere to put it, right? So it's such like a complicated, the carrier piece in acquisitions is such like a interesting puzzle to me.
And you bring up a good point when you talk about networks. There's networks all across the country. There are some that people join just to aggregate premium. Others do it for the back office support. I have some clients that have been in networks since inception, and others who want nothing to do with a network. And I just worked with a client that he's fully independent, not associated with any network, and bought a book of business that was tied to a network. And included in the purchase was the exit fee for that seller. That seller who was part of that network had to pay an exit fee when the book
Mhm.
was sold.
Yeah.
Right.
I will also tell you that not all networks are created equal, and a lot of people don't read that contract, unfortunately, and they get really far along this path and realize, oh, wait a minute, there's a first right of refusal in place. There's a clause here that, could change who my potential buyers are. And so even the carrier conversation, it will change who the best buyer is for your agency if you have one carrier mix versus another. That's where I think making sure that you're strategic about which books you're even thinking about buying makes a lot of sense. It's not always the case. There's a lot of times where people get super excited. They want to buy a book of business and they don't think about the impact of some of these factors, that maybe it's not the best book for them. And it's okay to pass on sometimes, right?
Yes. It's the thrill of the
Yeah.
hunt. I mean, I think it's people get so excited because they found somebody that is willing to sell to them or excited to sell to them. And you start digging into it and they want 3 times revenue, and the policies weren't set up correctly and the loss ratios at 87. I tell people all the time, not every deal is a
Right.
good deal. And it's okay to walk away.
Mhm.
I encourage people, if I think something looks hairy, I'm gonna tell them it looks
100%.
hairy. And I'm gonna say it doesn't make the most sense, because that book
Right.
you buy, that can bring down your existing agency.
Yeah. So what are some of your clients who have come to you, possibly first time buyer, what are some things that they bring to the table at that first meeting that really help them be successful throughout the process?
Ooh. First-time buyers?
Or people who just come to you are ready to buy a book of business. Like, what do they need in order to be successful and most efficient in that process?
I think understanding the inner workings of an agency and specifically the agency that they are looking to acquire. We talked a lot about the overall book of business. I mean, that's first and foremost. Understanding the inner workings of the agency from a financial perspective, understanding the total gross revenues, commissions, understanding the expenses of that agency, understanding the staffing and personnel and the culture of that agency. It, is it a scenario where all of the staff is nearing retirement and you're going to have to replace people? Are there 4 locations, like I mentioned earlier, and you can look to consolidate? I think that's important. I think really just understanding the financials, the book of business, and your plan moving
So,
forward.
Morgan, the other thing is their own personal finances, right? Like sometimes there's a guarantee involved. So, I think not being shocked by the fact that your own personal financial health is a factor in this whole process. And, you know, having your house in order. My favorite is I want to get a valuation, but I don't run monthly financials. Well, you're going to learn a lot in that valuation process because you haven't looked at the business from a financial perspective. And when you go to a bank or you go to someone like me, that's exactly how we're going to look at it. Because at the end of the day, you guys are having to make sure that the loan is sound and the deal works. So some of those things are just paying attention to the financials and the information and running it and looking at it, right?
Absolutely. So to that point, I mean, we're looking at the business, I mean, first and foremost, but we're factoring in the owner's, personal need expenses. Is your mortgage dollars or is it eight? The best is when you are looking at somebody's personal financial statement and they have a total of 4 car payments that equate to 6 a month, and they're thinking that they could buy and live off a 300 commission agency. You probably can't pay your bills off
Right,
that.
right.
But if your personal need is in line and matches with the cash flow of the agency, okay, there's a deal there. So I think really having, to your point, having your financials together, having your tax returns filed, that's an important one.
Mm.
No doubt.
Well, this was such a great conversation. I personally learned a lot. I know people who are listening to this will learn a lot. If they would like to reach out to you, where can they do that?
Absolutely. You can reach out. My cell, I'm over at Live Oak Bank. My cell, you get
Sure.
my number.
If you
Yeah.
want to.
I mean, is that typically how people do it?
They
And of course,
typically
we
give
know
an
the cell.
email address.
Yeah.
Okay, email address. Perfect. So they are welcome to reach out to me. I'd love for y'all to reach out to me with any questions. Feel free. You can bounce any ideas off me. My email address is Morgan at Live Oak, and that's MORGAN.HARRISS, 2 R's, 2 S's. So happy to help. Any questions, anything I can do to help, love to be a resource.
Well, Morgan, I appreciate you coming on and hanging out with us. I hope to see you soon. I know that we bump into each other occasionally whenever we're out and about. So I always look forward to those days. I can tell you that for sure.
Absolutely. Well, I appreciate both of y'all having me on today. It's such a treat, and I hope y'all have a great afternoon.